In this video, traders, we're going to look at what we call the knife edge trade. Stay tuned. Hey traders, a very warm welcome to you. Okay, so this is what we call the knife edge trade. It is for day traders. We trade it in the currency markets and we trade it on a 5-minute chart. It's probably, we're almost into scalping territory here, but you're going to see how it kind of blends in between scalping and day trading. So if you're an active trader, this is one to look at and potentially put into your trading library of setups. So let's have a look at the rules. Let's have a look at how we place the order, where our stops are, where our exits are, and go from there. Okay, so this trade is really designed to capture breakouts from small ranges. So we're waiting for a small range to occur. Like, for example, I have your US dollar up in front of me here. I have a 5-minute chart. We have a range environment here. Now, your valid question may well be, hey, how far is the range got to be? Is it going to be 5 hours? Is it going to be 5 minutes? Obviously, it's not going to be 5 minutes. That's going to be one candle. I would say the minimum you want is around about an hour. You know, if you're looking at your chart, you want to see an hour, and in my opinion, you've got to have this during the cash session of the currency you're trading. So what I mean by that, so if you're trading Euro US dollar, you really want it from between 8 o'clock till 9 o'clock at night, when those cash sessions are open, the indices are open, the indexes are open, that kind of stuff. You don't want to be trading this at 3 o'clock in the morning, because both of those underlying currencies, their economies are effectively closed. You know, I know we're 24 hours a day, but you get the point. You don't want that low liquidity environment. You want kind of some action going on. So you're in a range, you break out of a range. We're looking to get on board the first pullback after a breakout of a range. Now, in front of me, I have a 20 period EMA. That is the key to this whole trade. That's all we're looking at. We don't have anything else in this chart. It's just price action and a 20 period EMA. Now, if you're subscribed to the channel, by the way, appreciate your subscription. Thank you very much. If you are, you'd have probably seen some videos where we talk about 20 EMA with a lot of strategies. It's a really powerful kind of moving average. For whatever reason, it just seems to work. Anyway, this is a little bit different. We've got it on a 5-minute chart here. So EMA again, coming out of a range. Let's have a look at the rules. So we break out of the range, and what we're looking for is the first pullback that penetrates under the EMA in the case of a long, over in the case of a short. Let's keep it simple and talk about longs for now. So we're looking for the first penetration under that does not close under. So the candle has to have a little sniff below, price has a little look below, rejects it, immediately pushes back up or within the 5-minute candle period and closes above. When we see that, i.e. break out of a range, pulls back, penetrates through, closes above, bang, there is our entry. Simple criteria, but if you think about it in terms of supply demand, it's kind of looked below the 20 period EMA. It's encouraged buyers to step in. Buyers have stepped in within that 5-minute period or whenever it broke under, but we've got a small time period anyway that has to have done it. Hasn't closed below, pushes back up, closes, bang, you're in. Okay, so once you're in, now what? You take your long, and what we're looking to do here is scale out the trade in 2 chunks. So take your position, allows you to scale out twice, whatever size that may be. The risk parameters obviously going to come into your whole trading plan, whatever the total money you want to risk is. Now, where do we put our stop? How do we calculate our position size? Our stop is going to be below this low of the candle here. So in this example, what have we got here? 1.1694. We're going to have it 2 ticks below that, 2 pips below that in case of currencies. We don't want it any lower than that. This is really, hey, if this comes back below there, one out of it. Of course, we're going to get stopped out from time to time on these when we really probably shouldn't do. We've got to keep this one tight. The targets aren't massive. It's a scalping to day trading type thing. You're looking for that momentum. You don't want to give this too much room. So a couple of pips below that extreme. In this example, you're going to go 1.1692, give or take. Right? There's your entry. Now, when price starts going in your direction, you're going to split your exit up into 2. So you can have 2 exits. The first one is going to be equal to the stop loss distance. So if your stop loss distance is 6 pips, 15 pips, 12 pips, whatever it is, that's your first target. Your second target is going to be twice your stop loss distance. So if your stop loss distance again is 6 pips, it's going to be 12 pips. It's going to be 12, it's going to be 24. You get the idea. So very simple, very methodical strategy. You will get stopped out, but the idea on this trade is obviously you're going to make more on the ones that work than the ones you don't. Now, can you play around with this and do all on a twice your stop loss? Yes, if you're in the right market conditions and you kind of get a feel for when this works and when it doesn't. You don't need to be too conservative and have that scale out on the first kind of move in your direction. You can get rid of that. You can just go twice stop loss, or you can kind of get a bit more aggressive and go, okay, I'm going to do 2 times my stop loss, and then I'm going to have a third as a trailer, or my second as a trailer. Mix and match and play around with that, guys. You know the score of how that works. So pretty simple, pretty good stuff. Let's look at some other examples. I highlighted a couple more here, and obviously some stop outs as well, because it's very important that we look at the losers and how they affect us. Small range, is this enough range? Yes. Are we in the right time of day? No. Would you take this? You wouldn't, because you're 5 o'clock in the morning and we should really be past 8 o'clock. But the idea is, if this was 8 o'clock, we'd take it, we'd have to buy there, and we'd look to scale out. Let's have a look at some others. I've got another one here. This is early in the morning, so unless you were in US dollar JPY, you wouldn't take this, but the price pattern shows you exactly what we're looking for. The break out of the range. And this is interesting as well, guys. Okay, assuming we are taking this during the trading day, and we wouldn't because this is early in the morning, but this price action here is useful for an example, so take it for what it is. We are in a range, okay? We're in a decent range. We're not decent range, but we're in a range. We break out of the range here, we pull back, all of a sudden we're looking interested, but we close below. The candlestick closes below, and in fact the second candle just goes through and closes below anyway. Obviously if this is wick through and push back up, it would be a signal trade, but it doesn't. So because it closes below after being above, we don't even get involved in it. We're not even interested in it. The second time we do it, we break out to the lower end of the range, we push back up, we get a signal candle, we go short, our stop is where it is. So it works well because it keeps us out of the trades that we don't want to be in. Here's a trade that's a stop out. We've broken out of a range, really, I guess, from here. You can call this a range. This is where you've got to have a little bit of flexibility, right? This is, you know, maybe it's a bit of a downtrend, but in reality we've got a kind of resistance up here, and we've had a support here. We've broken out the range, pushed lower, and we pull back. So this would be not a bad little signal, and we do get an actual trade. But the important thing here is, even though we've taken the trade here, look how small the stop is, which gives you an idea that you can stretch this thing out and have some room to move. You can go strict and go 2 times your stop loss target, or you can play a game and say I'll split it into 3. I'll look for a runner, because the stop is so tight by the nature of the trade that it works that way. And that's what I like, these kind of things. Another one here, you haven't got a signal, unfortunately. You're in a nice little range, but you can see this would work very nicely. Long range after a breakout, pushes up, comes back. In fact, you have probably just got a little bit of a signal here, and you're stopped out. This is the way it's going to go. You're going to take a few tick stops here and there, but when it goes in your direction, you're going to get that many multiples of the scale, or you're going to add that additional trailer on. Okay guys, so that's the trading setup. Go and check it out yourself. Look at it in the markets that you like to trade. See if you can integrate it into your trading plan. Take care, good trading. Keep your risk managed. See you next one. Bye bye.